Hello, everyone. Thank you for joining us this afternoon. We'd like to thank the CFA Society of Colorado, Janice Henderson, and our judges for your time. We are here today to present to you our evaluation and recommendation for Helen of Troy. So let's jump right in. Our team today consists of me, Emily Nguyen. I am a Master's of Science in Finance student, originally from Fort Collins, Colorado.
My name is Jose. I'm also in the Masters of Finance, and I'm from Matamoros, Mexico.
My name is Matthew Walker. I'm from Richfield, Connecticut, and I'm an undergrad studying finance.
So jumping right in here today, we are issuing a buy recommendation for Helen of Troy with a target price of $140.36, a 29% upside from their closing price on Monday of this week of around $109. In today's presentation, we will make clear that through the investment tailwinds, combating against the headwinds, Helen of Troy is a competitive opportunity at this time. Helen of Troy is oversold, down 51% from their 52-week high of around $222. Helen of Troy has had a good record in a recessionary environment. They have a longevity of a management team that's doing interesting things with Project Pegasus, which I'll touch on in a moment. Cost savings will be realized through these efficiencies, and Helen of Troy also has a strong peer ranking and strong ESG performance. These are all things that we think are positioning Helen of Troy effectively in the current environment. Of course, there are headwinds of supply chain issues, short-term debt structure, inflation, and reduced consumer spending. But as of 6:30 a.m. this morning, the retail sales from January 2023 came out, showing that retail spending was actually up at 3%, beating the consensus of 2%. So this may not prove to be as much of a headwind as we originally thought. So starting off with a business description here, who is Helen of Troy? I'm sure you've heard a lot about this today, so I won't hammer this too hard. But they are essentially a consumer products company operating in 9 different brands, selling everything from Hydro Flasks to backpacks to cough drops to hair shampoos and curlers, things all across that portfolio. Helen of Troy recently collapsed from 3 business segments into 2 business segments, now operating in home and outdoor and that beauty and wellness space as well. Helen of Troy broadly sells to 3 main customers: Amazon, Walmart, Target. Those should be 3 of the biggest names you think of when you think of where consumers go to buy those types of products. And now I want to take a moment to talk about Project Pegasus. Project Pegasus is an initiative by the management team to expand operating margins and create efficiency for the company. The cost savings of this initiative will really be realized in fiscal year 24, 25, and 26, but with a one-time upfront investment of 85 to 95 million and profit improvements of around 80 million a year, we see a payback period of less than 2 years. They've already taken swift action, collapsing those business units from 3 to 2, and they will be laying off 10% of their workforce by March 1st, 2023. So the management team is very indicative that Project Pegasus is where they want to go. And then finally, just to get an idea of the scale, Helen of Troy does operate in 95 countries around the world, over $2 billion of revenue, so in that mid-cap size, and of course, those 9 brand portfolios. Now I'll turn it over to Jose to talk about our financial analysis.
Thank you, Emily. For industry overview, although Helen operates in various different industries, Value Line and Helen themselves are positioned in the toiletries and cosmetics industry, which ranked 53 out of 93 in timeliness, according to Value Line for January 2023. One great thing is toiletries is a defensive industry, while cosmetics are discretionary. As shown in this chart, Helen holds about 5% market share in an industry valued at roughly $40 billion. Lastly, Helen also possesses additional strengths, like its portfolio of leading brands, strong relationship with its retailers, and its continuous streamlining of organization through Project Pegasus. Next, we have our peer group ratio analysis table, and to avoid making this an eye test, let's just focus on the colors: green, yellow, and red. We ranked Helen with its main competitors according to Value Line, Value Engine, and Helen themselves. We score them assigning a point value of 1 to companies that perform above the median, shown in green, a point value of 0 to companies that performed at the median, shown in yellow, and a point value of -1 to companies that performed below the median, shown in red. We then tallied up the results and ranked them in descending order. And as you can see, Helen performed top of its class, coming in second place, tied only to Estee Lauder. For the last part of our financial analysis, we took a closer look at the trend analysis we gathered for the ratios we believe to be of utmost importance: Helen shown in green and the peer group median shown in blue. As you can see, Helen has consistently outperformed in the past 5 years, 80% of the time. It's peer group median in quality of earnings, shown by the high net income margin. Helen has also historically held a lower PE ratio than its median, indicating a possible buy opportunity. And lastly, it doesn't look like Helen will go bankrupt anytime soon, given its high Altman C-score. Now back to Emily.
Thanks, Jose. So before we jump into our valuation, we do want to take a moment to touch on ESG. Helen of Troy has really made ESG a strong priority for them in the past 2 years, creating a cross-functional company-wide task force and identifying that a strong and transparent ESG plan is a large priority. On the environmental side, Helen of Troy realizes that the majority of their environmental impacts come from their suppliers and their products. Therefore, they've worked with these suppliers and worked on packaging, looked at those science-based targets, new plastic initiatives, and things of that nature to ensure that their environmental impact is decreasing. They've also created brand campaigns with their brands OXO and Hydro Flask. Hydro Flask is a reusable water bottle company, so they have created a campaign to reduce single-use plastics. They've also looked internally at their products, and the beauty segment has created energy-efficient hair dryers that are up to 40% more energy efficient than products on the market. So from suppliers to brands to even their products themselves, Helen of Troy does care about the environment. On the social side, there is high levels of DEI in the workforce, more females than males and more ethnically diverse than non-ethnically diverse employees in the company. And they have internal programs as well as another campaign through their Hydro Flask brand. On the governance side, we saw no agency issues. There is increasing diversity on the board and no compensation issue either, shown with that Say on Pay 98% approval in their annual board rating last year. But don't just take my word for it. Let's take the word of Sustainalytics, a Morningstar company, and how they are evaluating ESG. As you can see here, Helen of Troy has the lowest ESG risk rating, which is the best thing in this type of scenario. What Sustainalytics does is they look at material ESG issues, corporate governance, and idiosyncratic issues to evaluate whether or not ESG poses a risk or an opportunity for a company. For Helen of Troy, they are outperforming those peers that Jose talked about a minute ago, and have a low risk level for ESG. And I also want to touch on this no apparent greenwashing. Greenwashing, many of you in the room may have heard that word, but it's essentially, is the company walking the walk as they talk the talk? Are they doing what they say they're going to do? Based on our analysis and based on these sources, we do believe that they are in fact doing what they say they will do. Now I'll turn it over to Matt to talk about our valuation.
Thank you. There are 5 key considerations for evaluation, and we have ranked each consideration on a low to high probability scale and a low to high material impact. Starting off with an economic recession, we are predicting a 50% chance of an economic recession to occur. However, fortunately for Helen and Troy, they have 1, diversified revenue streams, as well as selling essential and elastic products. Next is supply chain. 88% of products produced derive from Asia, particularly China and Vietnam, exposing Helen and Troy to political affairs between each nation. Lastly is Helen and Troy's debt structure. Helen and Troy has a variable debt structure based off of SOFR. And as you guys know, over the past year, the Federal Reserve has been raising interest rates. Therefore, Helen and Troy is now paying more in debt than they initially were. We are issuing a buy rating with a price target of $140.37, a 29% upside to today's price. As you can see on the chart to the top left, Helen and Troy's 52-week high traded as high as $222 compared to $108 where it is trading today. For evaluation, we went with 2 valuations. We did an absolute valuation of free cash flow to firm, as well as a market-based price to earnings. As you can see in the price to earnings model, our EPSs have a wide range. And this is because we went with a conservative approach for our EPS, as during the great financial crisis in 2008, Helen and Troy had an average EPS of around $1.50 earnings per share. And on the bottom chart here, you can see that we have assigned an overweight to the free cash flow to firm valuation, as the valuation considers time value of money. To conclude, while considering investment tailwinds and investment headwinds that Emily previously talked about, we are very confident that at today's current price of $108, Helen and Troy is undervalued. We are projecting a total return of 29% over the next 12 months. Plus, Helen and Troy has a low beta, meaning Helen and Troy is a great defensive stock during economically uncertain times. Thank you. We are open to questions and answers.
Thank you. I'm going to reset the timer. And as soon as the judges are ready to start asking questions, I'll restart that timer.
Perfect.
I think you're a bit rushed at the end. Could you explain the difference between your valuations that you came, the PE and the cash flow valuation, the 150 and 119?
Yes, of course. So
They're so varied.
yeah, so on our appendix side, you can see that we went with 3 different scenarios. We went with a bear, neutral, and a bull case. And as you can see, we have assigned different growth rates, and these growth rates are based on historical trading patterns. So during the Great Financial Crisis, the 2% revenue growth rate was during the Great Financial Crisis. Helen of Troy was able to have a 2% CAGR from 2007 to 2009. And again, for our neutral case, we have that was at the 10-year trading average, and then our bull case of the 10.9% revenue growth rate was derived from the past 4 years as well.
How do you determine what the PEs should be for each of those?
Yes, so the price to earnings are again historical. So during the Great Financial Crisis, for our bear case, we had Helen of Troy was trading at about a PE of 9.7, and then same for the base and bull.
Do you incorporate further future mergers and acquisitions?
So actually, something unique about Helen of Troy is they have a revolver debt structure, and they have used up with the Bank of America, and they have used up pretty much all of their debt structure. So there's a lot less room to grow through acquisitions as previously for Helen of Troy.
And adding on to that, in their earnings call, the most recent one in January, they talked about they're looking at a few projects, but more focusing on their legacy brands, those 9 brands in the portfolio right now, trying to kind of contract a little bit and grow from where they are instead of actively looking for new companies at this time.
On that kind of heat chart that you did, the green, yellow, red, you scored Helen relatively strongly versus competitors, but the next slide, you also show they've had a pretty sustainably lower PE in recent years. Why do you think that, relative to peers, why do you think that is? If it's a better company than its peer group.
Do you want to take over that one?
Yeah, of course. So Emily, can we go to the slide, the appendix slide where we have the why the stock price has been depressed recently. So, sorry, one sec.
There we go.
So as you can see on the graphs to the right, more recently than not, Helen of Troy has had unfavorable sales impact in the beauty and the home and outdoor section, as well as higher EPA compliance costs. So therefore, we felt that the market was pricing in that into the stock price.
They were supporting their stock with share repurchases also. What would your advice be to management on reinstituting share repurchases?
Personally, I think since there's such uncertain future over the next year, I think holding off on repurchasing shares and just saving as much capital as possible in case a rainy day comes, it'd be, I guess, nice to have a kind of parachute to fall back on instead of repurchasing stock.
Yeah.
What are your revenue assumptions when you're talking about the 29% upside?
Yes. I believe that was here.
So here we just have a list of all of how our revenues are calculated, and then as you can see, all of our revenue CAGRs were based off of past historical revenue CAGRs.
Why'd you weight free cash flow at 2/3 weight and PE at a 1/3 weight?
Yeah, so we decided to go with that extra weight because it considers time value of money. So we projected cash flows and just presented them back to present value, and we felt that was a much more accurate, accurate valuation compared to the price to earnings model.
When you consider their different businesses, I know they're combining 3 of them,
Mhm.
2 of them into one. So if you think about like health, beauty, and wellness, I think is the performer and outdoors. How do you think about those 2 different subsegments and how they should contribute to growth going forward?
Yeah, absolutely. So the idea of Helen of Troy consolidating their business segments is largely to decrease overhead costs. So they're consolidating, I believe it's the marketing and finance departments and operations in between those 2. But, I'll be honest, they are 2 very different revenue streams. And so I think the management team is trying to focus on working proactively with Targets and Walmarts to make sure that they're stocking those on their shelves. They talk a lot about working with those retailers to, manage supply chain, manage the amount in inventory. And they also try to create each brand to have a unique identifier. And before we did this project, many of us didn't even realize Helen of Troy owned Hydro Flask and owned Honeywell. So I think as a company, they realize the brands are what consumers recognize, the brands are what make them money. So they focus less on the Helen of Troy brand and less on unifying that, besides costs, and more on the individual brands that way. So that's how I see the combination there. Yeah.
How are they doing on managing their distributors, Walmart and Amazon and that? How are they managing those relationships? Because they have a lot of power.
Yeah, so they talked about that. I believe it was in their most recent earnings call as well. And they talked about co-marketing relationships with these companies. So people will come to Walmart or come to Target to buy a Honeywell or a Braun, humidifier, and Target and Walmart need to recognize that. And they also, it's a little bit of a unique structure, right? Because Target and Walmart maybe have their own brands that sell the same things. So I think Helen of Troy is proactive. They have frequent communications with these retailers about how much stock they have in inventory and things of that nature, so that they're trying to get customers into doors at the end of the day. But it is kind of an interesting balance, you're right, about how do they deal with those retailers when they're selling similar products. So I think it comes down to communication.
On the distribution side, I don't remember what number, slide 4, I think, you list the 3 distributors.
Yes.
And Target has dropped off, or it's a much smaller, not much, a couple percent. Is something going on with that relationship? Is there a change or strategy that we should be aware of?
Yeah, there wasn't anything material we saw with Target. I do think that some of these other companies, Amazon, for example, rarely increased their market share in the last couple of years. And so I think it's broadly due to factors of that, not reflective of Helen of Troy, but more reflective of Target in general and how many consumers are coming through those doors.
How are you assessing the likelihood of gross margin and operating margin trajectory in terms of, their ability to price relative to their costs?
Yeah, I can start on this, and then Jose, if you want to jump in. So if you look at gross margin here, we do see that as one of the lower levels. But as Helen of Troy positions itself in the competitor group of toiletries and cosmetics, think about some of these companies here. Elf Beauty, Estee Lauder, their products are very high priced for the cost that it takes to produce them. Makeup is an area where you can maybe spend $40, $50, $60 on a product where it doesn't cost that much to make it. Helen of Troy has a lower gross margin because they do tend to have lower prices across the board. And Jose, I don't know if you want to add on that.
Yeah, and another thing that we think is very interesting is that at least when it comes to the gross margin factor, what they miss out compared to its peers, they make up at the end when looking at the net income margin.
They are operating with in a tax haven, Bermuda or Barbados, right? How is that affecting their net income margin going forward? Do you see risk there?
Yeah, of course. Well, actually, something unique. Helen of Troy has about a 13% tax rate, so that is very obviously good news for Helen of Troy, with corporate tax rate being much higher. So obviously, it gives more capital back to the company where they can spend it elsewhere.
Do you see any risk to that going forward, that low tax rate?
Obviously, tax rates, they could rise at any moment. Therefore, there could be unpredictability within the future for cash flows, as again, depending how the White House goes, if it's Republican or Democrat, tax rates could increase or decrease. So I think just trying to be as conservative as possible for Helen of Troy would be the best course of action.
Yeah, and the company did tell us, that was one of the questions we asked them in the question and answer period. Is there any strategic reason for that overseas location? They said, nope, tax. So, yeah.
If you were going to put capital into any one of the divisions, the beauty or the wellness or whatever, where would you advise management to invest the capital first and foremost?
Yeah, so I would actually say the beauty and wellness side right now. They also have some branding with Revlon. That's a very large name in the space. And with us saying that toiletries are less of a discretionary situation than cosmetics, I think this is a more long-term growth. Shampoos, conditioners, things of that nature. I think if the company gets into that area of business, they're going to have more loyal customers than people that buy a hair dryer or buy a backpack or buy a Hydro Flask one time.
How do you think their products will travel internationally?
So I can take this. So actually, so as you can see here, so the revenue breakdown geographically is very centered in the United States. So again, they don't have a huge presence in Europe, Middle East. Perfect. Thank you.
Sorry. Awesome. Thank you for your
Yeah.
time.